Hello traders, Gary Wagner for Trending Markets just after 12 noon in Honolulu, dinner time in New York, 5 o'clock. The equities markets have closed for the day. They have been closed, of course. Globex and the E-mini is trading. We will take a look at that in a second. But we had the Dow Jones Industrial Average really moving from positive to negative territory throughout the day. In essence, it closed unchanged, but it did close off by about 4 points on the day at 17,732.75 with a low of 681 and a high of 772. So we're seeing a very, very tight range, especially to the upside. And the net result in terms of the candle that we're seeing on our daily chart in the Dow Jones Industrial is simply a doji. So we're having a day of consolidation in the market, very similar to what we saw a couple of days ago right in here. Now, the dojis can be significant, but they, in terms of creating or defining a pivot point in the market, a key reversal area, but they also define resting areas. And you can see the resting areas as the market goes up, for example. You can see that right in here. Let me get my pointer. I apologize, but you can see that right here where the market is genuinely moving higher and then resting, moving higher and then resting, moving higher and then resting. So it's not necessarily a sign that we're got some sort of a key reversal that is imminent. It can be a rest area, but it can also be a sign. So we want to pay close attention to that. Now, in terms of what we're looking at with our Standard & Poor's trade, Standard & Poor's closed at 79.25. This, of course, is the E-mini, down about a half a point on the day. And when we look at the marketplace itself, and the best way to do that is to pull up our daily chart, we can see a couple of things. First of all, we did trail our stops up yesterday. Our stops are sitting roughly at 2043 to 2045, right in this area. Right here is where our stops are currently at. And of course, to me, the key area that we really need to watch more than anything else is this 200-day moving average, because that has been so decisive in predicting large moves in the market. As we've said before, you can see points in time in which we broke, and I'm really going to have to compress this chart and let it fill in, but we have seen points in which this market has in fact broken below the 200-day moving average, but done so just for a short period of time. And you'll have to excuse me, but to really illustrate that point, I really had to compress this chart to bring in some time because it is a daily chart. But again, this blue line right here, this is our 200-day moving average. You can see that there were obviously points in which the market was below it, this being a pretty sizable correction here, but you can see points in which it dipped below it just very, very briefly. And then this, of course, is 2013. We go into a major run in the market. It stays above this line for the longest period of time, really through October of 2014. That was this particular sell-off. Market trades, and then you can see how eloquently this particular market, or this particular study, defined the market. I'm just trying to line it up because you can see that it was providing really good support. It came down a little bit, and of course the August meltdown, which occurs right here, that was our signal, was the fact that it broke through there. So we can see false positives, of course, that this market might in fact break down. But for the most part, this has been just a very, very good indicator of the marketplace and the conditions of the marketplace as it relates to our current price. So my recommendation is to maintain our current long position in the S&P, obviously. Maintain our current stop. I'm not really looking to move that, and see what we genuinely see as this market unfolds. The weakness today, according to many analysts, is the fact that now the anticipation of a rate hike is pretty much at 80 or 90%. It's pegged at the top end of the range. And so the question becomes, how orderly will these rate hikes progress? In other words, will they be out throughout a long period of time or a short period of time? The Fed has been transparent. They have said it's going to be an orderly progression. I would look for every 3 months to maybe see a quarter-point rise, but that's always going to be data dependent. The Fed has done a great job, as far as I'm concerned, getting this economy back on board, and it is time for that rate hike. And hopefully when that rate hike is implemented, or I should say if the rate hike is implemented next month, which I believe is highly, highly probable, that it won't really spook the market out that much. I think the Fed has really worked to mature the trading audience enough to know that this is coming. It can't take really anybody by surprise, but we'll have to see what happens. Again, maintain your current long position, maintain your current stop. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for the weekly wrap-up in trending markets. Bye-bye.